Welcome to the Flow Tracy Money Audio Commentary. This is Owen Tracy recording, and it is 3:41 p.m. and that is Central Time. And today is November 2nd. It was a big day in markets today. Basically, I think everything flows from the conclusion from the Fed meeting yesterday that we're at the top of the interest rate hiking cycle. Then you had the Bank of England coming out and saying, well, you should be prepared for rates to stay higher for longer, but they didn't raise rates. And then the bond market in the UK is pricing in 3 interest rate cuts next year rather than listening to the Bank of England. And 10-year Treasury yields were down another 7 basis points today, so it's looking like at least near-term support in the region of the 5% level and potentially medium-term support. But we had a broad rally in government bonds just about everywhere. So gilt yields have really been outperforming for a while because they haven't broken down to new lows. And they did, and then the yield contracted in here today. But German yields also paused in their decline today. But the big rally that we saw really was in China, where China's government bond yield really surged lower. Bond prices rallying and a big contraction in the yield. So when we think then about what's going on here, well, I think in many respects people are starting to price in the potential that we're at the peak of the interest rate hiking cycle, that inflation isn't something that we need to be particularly concerned with in the near term, and that perhaps we should be starting to dust off the deflationary playbook. Now, when we look at what's going on in China, well, in China, the number of outstanding mortgages contracted for the first time ever. And contracting numbers of mortgages, that's not unexpected in lots of countries. Because in order for the number to continue to rise, you need to be selling more houses than the number of loans that are getting paid off. So if you're not making any new loans, well, then the prepayments and the repayments are going to start to eat into the number of outstanding loans pretty quickly. But China has never seen the number of outstanding mortgages go down before. So this is certainly an indication that the issues in the property market are not just going away, and that there's going to have to be a lot more stimulus. And I think this really does raise the important questions, something that everybody's really asking right now. Where's the money going to come from? Where's the stimulus going to come from to really help to reinflate asset prices? We've gone through 15 years where we've had this phenomenally large bull market, and it has been driven by liquidity and the willingness of the Federal Reserve to keep rates low for long times. When they talk about keeping rates higher for longer, then what does longer mean? I think is another big question that people have. It's certainly not going to be as long as they kept rates down for, where they went for years without raising interest rates, and they continued to inflate the size of their balance sheet. So that was one of or perhaps the most important factor in inflating asset prices. Everything from bonds to equities to properties went up in value when interest rates were zero. So everybody wants to go back to those easy days where it didn't matter what you bought, as long as you held on to it, it probably was going to rise in value. And of course, you had then the Fangman companies that did spectacularly well on the back of 4G and access to liquidity. Well, potentially China will be the place where we get more liquidity. We're definitely getting Japan. They're not pulling back from supplying liquidity, so that's one potential source. But I think what most people will be looking at is, what do the ECB, the Bank of England, and the Federal Reserve do? Are they going to stop raising interest rates, stop reducing the size of their balance sheets, begin to cut rates, and will we see even more fiscal spending? So certainly there's lots of charts to pay attention to. And of course, we've just had Apple's earnings